What caused U.S. stocks to turn around? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Jared Dillian, editor of the Daily Dirtnap newsletter, and Real Vision's global editor, Weston Nakamura. Hi, gentlemen. Thanks for being here.
Hey,
Hey everyone.
So, wow, what a round trip, Jared. This looked like it was shaping up to be going to be a horrible day. We saw a really steep sell-off. We got a hotter than expected CPI reading here in the U.S. And then about midday, we saw a huge turnaround. Um, what do you make of it? Why do we see that happen?
well, I mean, a lot of people are trying to interpret this move in the context of CPI, right? They're saying, well, maybe people are realizing that CPI is lagging and that this is actually the peak in core, and that's why we rallied. Doesn't have anything to do with that. The reason we rallied today is because everybody was limit short, and they they crashed S&P futures 100 points on the number, and there was nobody left to sell, and people had to cover. I mean, it was pure positioning. Like if you look at the chart of the S&P today, it exploded higher around 10 or 11 o'clock. I mean, it was a pure short covering move. Now, the question going forward is this going to turn into some kind of durable rally? And I think it is. First of all, just the amount of shorts that we have in the market, they're not going to all cover in one day. It's going to take a long time for this to come out. But I also think that you're going to see the bond market this morning after the CPI number was under a lot of distress. We came within a couple of ticks of the long bond to having the whole yield curve over 4%. Twos were trading around 4.5. I mean, one thing I pointed out on Twitter today, the on the run bond was trading in the 82 handle this morning. This bond was issued on August 15th, 2 months ago, not even 2 months ago, and this bond lost 18% in price. So
Wow.
you've seen some massive moves in the bond market. So I think we're going to get some more dovish comments out of the Fed. I think we're going to get some acknowledgement. If you look at private measures of inflation, a lot of that seems to indicate that inflation has peaked and is going lower. So yeah, I think it's higher from here.
Uh, that's incredible. And there's stuff I want to unpack on there, but I want to fill out this, like, don't just make this, this link that everyone's making, including a bunch of people that you may be seeing on some outlets about the CPI and the turnaround. And Weston, fill in the other part of this for me because Jared, and by the way, just pause 1 second. I just want to say that, Jared, to your point, as I'm just looking as you're talking about that, I saw that you tweeted a couple of days ago, everyone is bearish. Everyone can't be right. You also, I think yesterday, I'm going to pull this up because while you were talking, I got your note. You may think it hinges on the CPI print. Probably not. Actually, in my experience, when things are this one-sided, even if you have a bad outcome, the market rallies anyway. Shorts have to cover. You wrote this, or you put this out there yesterday, I think. And Weston, you have also been warning us for weeks that we shouldn't be so US focused and we shouldn't just be looking at the equity market. So talk to me a little bit about what you were watching as this massive turnaround unfolded.
Sure. So Brian, if you put up that first chart, in terms of answering the question of what was behind that kind of intraday rally post this pre-market CPI, in my view, that was clearly the UK and events happening in the UK, specifically with what's been happening in the last 2 weeks regarding the crisis that is very much not over and is coming to some sort of conclusion tomorrow, Friday, with the Bank of England, who has been stepping into the gilt market, the long end of the UK bond market, sovereign bond market, and essentially flipping from QT to QE in order to sort of put a backstop and kind of rescue UK pension funds. And that program, that 180-degree flip, ends tomorrow. But that is a crisis that is far more serious and imminent than a couple basis points miss on US CPI. So what you saw was in that first chart, you'll see that sell-off along with, GBP, USD and all that. But then you see that midday rally. Now that is not CPI related because the new data came out 3 hours later. It takes a long time for everyone to read and then read at the same exact rate and pays on time, right? So what you got was headlines coming out of the UK that were, I mean, there were, so many of them, but by and large seen as positive for, what may come of tomorrow and then therefore beyond, regarding like this UK kind of disaster that's been overhanging. And so you get that, and then as Jared said, you get a short squeeze, and you get a short squeeze in everything. If you look at like cross sector, you see like semis and all that. Basically everything has been rallying that got beaten up. So it's just so many people who are just very very kind of eager to just either short cover obviously but just to buy what they think is the floor, even for kind of a short term basis, and that's the price action you got. But it was not CPI related. That first down move that you saw, that was CPI related. After that, that's not CPI related anymore. SPX, and this is not just SPX. This is global indices. This is obviously Euro stocks, the Nikkei, all that too, Bitcoin, risk assets in general. But they all moved up in tandem, and the S&P 500 is not a U.S. asset. It's a global asset class with global investors, and it is very much hinged to some of these other markets and major markets and developments that are happening within, such as the UK.
Yeah. And that, putting these two together makes a whole lot of sense because it did seem to come out of nowhere, and it didn't make sense for it to be about the CPI. Jared, when we're talking about whether it's durable or not, is there so much of what we're seeing, and if we think it, the Fed may start to be a little bit more dovish, which you just mentioned, is that going to be because something is happening in terms of the financial system? There's some sort of dislocation, something's blowing up somewhere in the financial system, because the other reasons they would pivot aren't there, right? The inflation story is not going their way to even give them the cover to say anything. Are you worried that it's something else happening that's going to cause the pivot? And then what does that do to this rally, if that makes sense?
No, I mean, first of all, the mandate of the Fed is price stability and unemployment. It doesn't say in the mandate that the mandate of the Fed is stability of the financial system, but that's absolutely what it is. Like, if the Fed can fight inflation, the Fed can try to save us from inflation, but if they blow up bond markets around the world, there's not going to be anything left to save.
Right.
So you've seen this argument out of a couple of Fed speakers in the last couple of weeks that we've already done a lot of rate hikes. And by the way, these are the fastest rate hikes in history, the fastest. So we've already done quite a bit of rate hikes, 350, 325 basis points so far. We're going to do 75 or whatever in November. Why don't we pause and wait and see the lagged effects of these rate hikes before we pile on the bond market and crash the bond market, So I think that there are some reasonable people at the Fed. I also think there's some unreasonable people at the Fed, people who maybe don't have market experience or don't understand the consequences of taking mortgage rates up to 8%, So I do think you're going to see a change in tone. I had said all along that the Fed was going to hike until something broke, and what broke was the UK bond market. And the U.S. bond market is pretty close, as of this morning, was pretty close to breaking.
Yeah, I just we shouldn't forget that they're all in Washington together, right? That most of the finance ministers and bankers are at the IMF, World Bank, the International Monetary Fund, World Bank, these big multilateral international organizations. They have these annual meetings, and they're all down there together. That's when every time they've been speaking, it's been causing turmoil in the markets, whether it's Bailey or Kuroda. So they're all together. Presumably, they're having some pretty intense conversations about what's going on and where the danger might be when it comes to whether a UK situation could spill over and show up here as well. In our asset management industry. Weston, this makes me nervous though, because we're waiting for we've got policymakers that need to potentially do the right thing or change their tone. We're also going into this Friday, which is already Friday for you, but we're going into this day with this big line in the sand that the BOE put down. I mean, is there an assumption on the market that the UK government is going to cave and pull back that budget that caused this latest, or are we being too complacent thinking that they're going to do the right thing? I mean, these are politicians. I shouldn't say right thing. Do the thing that will take the pressure off. I'm not editorializing what the right thing to do is, but
yeah, I was gonna say what's the right thing, what's good. Those are all
what would calm the markets.
And to Jared's point, Brian, if you pull up the chart to this is intraday today, because people are talking about, okay, so the equity market had this reversal, but what about the bond market? This is intraday. The UK 30-year yield, the gilt yield. This is the tenor that one of the tenors that the Bank of England is directly intervening and buying, and that it's going to stop doing so tomorrow, supposedly. And as of, I believe it was 2 days ago, Maggie, to your point, what you were saying, Governor Bailey said, "Hey, you pension funds have 3 days left to unwind or to rebalance your portfolios." And then this QE, temporary QE, is indeed temporary, and that goes away. And that's just how it's going to be. And as you were talking about with Sri on RVDB, what was it, 2 or 3 days ago, that I had the same exact sort of reading on that. What he was saying, he's not talking to the pension funds per se. The pension funds know what the date is. They know that they have till Friday. What he was saying was the Liz Truss government, essentially, and saying, right, hey, you and Kwasi Kwarteng, the Exchequer, the Chancellor of Exchequer, you need to get your act together, as in you need to change your language or your policy regarding these sort of unfunded tax cuts and all that, or this is now on you. And should the pension system blow up, should the long end of the gilt curve just explode higher, that's on you, right? But the reason that matters too is because, Brian, if you go to chart 2B, this is just a chart of the 30-year UK gilt yield versus the 30-year US Treasury yield. The long end of the US Treasury curve has been, over the last several weeks, or since the end of September, has been pushed around and shoved around by developments that are happening in the UK and the UK bond market. You see massive swings. You see 20 basis points or more intraday swings in either direction. That's becoming kind of an everyday normal thing in the UK bond market, but that's spilling over directly into the US fixed income market. It's not just the US either. It's global DM fixed income markets. They move more or less together. And that's why you see these huge spikes at the long end of the US yield curve. And so a lot of that was being kind of that's the baggage that we were coming into CPI as well. This sort of external UK development that's going on, that's influencing the US Treasury market. So you can't just look at the US Treasury market and US CPI and then that reaction in sort of isolation. You have to know the context beforehand, and you have to know what is ahead and what kind of sort of developments are going on as these figures are dropping, right?
Yeah, absolutely. And I think we have everyone who's been on this week has been doing a really good job of trying to pull back, the simple explanation and really fill in how all of these different markets are impacting each other. Jared, I'm really interested to hear you say that you think that this rally might be durable, because it seems like there's so much risk. I mean, it just seems like inflation's not giving the Fed any cover. We saw how quickly these treasuries are moving, and they're, these markets aren't really, meant to be moving that kind of quickly. You hear people saying maybe there's derivatives that could be involved, and, it'll cause strain in all sorts of places. Now we're looking at this game of chicken for the BOE and the UK government. There just seems to be so much risk out there. Will is just writing in from YouTube, how soon is this all going to blow up? I mean, it does sort of feel like that. You're a master of sentiment. Why do you think this might be durable? What are you basing that on?
Well, first of all, a lot of the bears out there, they look at the stock market and they say, okay, the stock market's down 22% or something like that. And, we were down 57% in 2008. We were down 48% in 1974. We were down 89% in 1932. So we've had bigger bear markets. And if you look at the confluence of factors that are affecting the market, whether it's inflation or recession, I mean, it's just a pile of shit all at the same time. And so people say, well, why isn't the stock market down more? And so they kind of believe that things aren't that bad because stocks are only down 20%. But what you have to understand is that bonds are down 20%, commodities are down, every asset class in the world is down. There has been absolutely no place to hide. The only people who have succeeded for a short period of time were hiding out in energy, and that's not working. So really, the only people who are who think they're smart at this point are people who sold everything in 2021 and went to cash. And I don't know anybody who did that. So everybody's getting hurt. And I would say this environment is just I want to say just as bad as 2008. 2008 was definitely worse, but it's much worse than you would believe just by looking at the stock market, right? It doesn't tell the whole story. So this is a really, really bad bear market, and it's one of the worst in history. And honestly, I think there's a limit as to how much it can go down.
Yeah. Weston, we haven't even talked about what's happening with the dollar and the moves we've seen in the yen. If you want to layer on to this complicated cake we're building here, we have a huge event coming in China as well. I mean, I think this is another thing, like when you're looking at what everybody's thinking or what they may not be prepared for, which is what, if I hear you, Jared, is what you're saying. Like, you can't look back. You've got to look at the thing that people are not anticipating.
Well, I mean, the bear case is always most compelling at the lows. And the bear case was the most compelling at 8:30 this morning. That was the moment at which everybody who was short was vindicated. They were absolutely right. And that's probably the time to buy. I've in the last couple of months, like, people are starting to call me a permabull on Twitter, right? And now, Maggie, you and I have been talking for a while. Like, I'm not a permabull. Like, back in 2020, 2021, I was very bearish. And basically my shtick is that I pay attention to sentiment, and when sentiment gets really one-sided, you usually set up for a reversal. And these reversals are tradable. Look, like, I'm a counter trend trader. It's just the way I'm wired. And I think we could have a 10 to 20% counter trend rally within the context of a bear market. Or the other possibility is we just put in the bottom of the bear market this morning, and that was the bottom. That's also a possibility. We won't know that for sure until we let this play out over a course of weeks or months. But you have to entertain that possibility.
And I think that is where you're going to, if that's the case, then right now it seems durable. You're going to retest that theory, though, once you start to get that either 10% or 20%, because you need to figure out at that point whether it is just a strong bounce in a bear market, or whether there is something more substantial going on. Is that right?
Yeah. I mean, the rally that we had in June, which was a 17% rally, kind of off of similar circumstances, that rally never felt good, right? It was a short covering rally, and it never felt good. Felt like a Fugazi rally, and eventually it kind of went longer than I thought. I thought we were going to bounce around 10 or 12%, and it actually went a little bit higher. But I don't know. We'll see what happens this time.
So, Weston, relative to what we've been seeing, you've been talking about the need to watch the currency markets as this cleanest signal in this, crazy market environment we've been in. How important is it for the dollar to retreat if we think we're going to be if this is going to be something more durable? I mean, presumably the dollar can't just keep strengthening and putting pressure on the global system if we are going to bottom here.
Or perhaps it can for at least maybe a little bit longer than we'd all hope. So as you said, all of the G7 and G20 finance ministers and central bankers are gathered in Washington at a pretty good time. Given everything that's happening, a lot to discuss. But out of that, and this is actually in relation to intervention, kind of an update from that, because I put out a thread about that earlier. But so the CPI comes out. Now we're looking at the yen in the 147 handle, dollar yen that is. But Brian, if you bring up chart 3, so 147, yeah, that's very high. That's I've lost track now at this point. The 30 something year.
Yeah, I think it's 30.
Yeah. But if you look at that chart, basically, when the Ministry of Finance in Japan, via the Bank of Japan, intervened in the FX markets unilaterally without the permission of the United States Treasury and blasted $20 billion directly into the FX markets and capped USD JPY's upward runaway surge, that made it an artificial market. It currently still is. And so what you're looking at in that chart is that's the U.S. and Japan 10-year yield spread, nominal yield spread, which closely tracks dollar yen as yield differentials, fundamentally in terms of price action, reflect those respective currency pairs. But you can see that the U.S. to Japan 10-year yield spread has been absolutely blowing apart because Kuroda once again in Washington this week repeats that the Bank of Japan governor repeats that JGB yields are going to be capped. And meanwhile, you have 10-year U.S. Treasury yields surging because of, by and large, the UK and developments that are happening there. And so when that yield spread is blowing apart, you see that dollar yen has not been keeping up with that yield spread. And so at some point, those are going to have to converge. Either that yield spread has to come down, which is what the Ministry of Finance is trying to do, to try to buy time so that you get like some sort of recessionary sentiment to come in, bid back into treasuries, yields to come down, yield spreads to collapse, dollar yen falls, or dollar yen stays the same, and the yield spread falls back to where the current levels are. But if that doesn't happen, you're looking at a very artificially, strong yen, given the sort of fundamentals. So to answer your question regarding like the USD strength, it's going to be again you can't look at a DXY sort of thing. It's going to be case by case. And in Japan's case, they're clearly intervening. You have to look for what's round 2 going to be. Are they going to let a 150 print get out there? Are they going to step in before that? They're threatening, that they're going to be doing that. But meanwhile, they just met with their counterparts and they probably were not given the green light to just keep doing this. At the same time, the UK has its own currency in flux with that situation. So everywhere is going to be sort of different. So when you talk about the dollar strength, it really has to be, you really have to specify against what currency and, what's happening within that region idiosyncratically as well.
Yeah, because it's sort of every man for himself in terms of what they're dealing with, the risks they're dealing with their own economies. So, Jared, would you be a buyer? Would you chase this rally? Because short covering rallies can be difficult, can't they?
I would absolutely chase it. Let me make a comment around that. So,
Sure.
Markets discount things. Okay. So market was up 2-3% today and nobody knows why. Well, the market is discounting something that's going to happen in the future. So what that means is that we'll find out why the market rallied today at some point in the future. And, earlier in our conversation, I was talking about, I thought we would get some dovish comments out of the Fed. Well, that I think will happen, but it won't happen until after stocks are already up 10%. If you actually wait for the dovish comments out of the Fed, you will have missed the entire move. So that's why sentiment trading is so useful, is because you're buying into extreme sentiment, which is in itself an act of courage. Because, this morning at 8:30, there was absolutely no reason to buy stocks. There was no compelling reason to buy stocks at all, and ended up being the best time to buy stocks. So one of the things I talk about in my newsletter sometimes is that trading is often an act of faith, right? And traders are very skeptical people, right? They want to see evidence before they do something. They want to see the fundamentals get better. But you don't have time to wait for the fundamentals to get better. You have to have faith that it's going to get better. And the evidence that you have is the messages that people are sending around you, the stuff you hear on Twitter every day. So,
Yeah. But by the way, in our own questions, we have some people asking, is Credit Suisse going to implode? I mean, you can feel the worry out there. Do we sell? Joe asking, do we sell into today's rally? Joe, I think Jared just said he wouldn't be. He would be chasing it a little bit. It makes me think of, Jared, I just did a podcast taping with Ralph for My Life in Four Trades, which is going to be really fun when it comes out. And he's talking about other people's trades. And at one point, and there are some smart people right now who are gaming things out, and they're not just trading one step ahead, they're trading two steps ahead. And this feels a little bit like there might be some of that going on too, because they are, as you say, anticipating what's going to happen and making sort of, a faith-based bet, or what they think might be a convicted bet on that. Do we need, is this whole indicating that something's breaking and that people think the pivot's coming because something's breaking? I mean, is it possible that there's something going on that people in the industry see that we don't see yet, but that the secondary effect is that they know the Fed's going to pivot because of this, and then that would be positive for risk assets? Is it possible something like that's going on?
That's entirely possible. I was a trader for 9 years, and I can tell you that, I was just a VP at Lehman Brothers. I wasn't anybody special, but being on the trading floor at Lehman and talking to the head of equities and other MDs and stuff like that, like, I was pretty plugged into information. And if there was any kind of rumor or anything about something blowing up, like, I would have found out about it on the trading floor. I'm sitting here in Myrtle Beach, South Carolina. Like, I have no idea what's going on, so, like, sure, like, there could be some systemic risk out there that we're not aware of, which would cause, financial stability risks, which would cause the Fed to pause. That it's possible.
Yeah. I mean, again, we're not saying that's the case, but I think what we're just trying to underscore is that these are very complex relationships. And
to that point, that you were just yeah, because it really depends on the context of like what this Fed pivot would be. But like, just like you guys are saying, just like Jared is saying, look, if the Fed has to do what the Bank of England has been doing the last 2 weeks, as in they pivot and start buying U.S. Treasuries, but they're doing so in order to cut the wire at the last minute before a bomb goes off. No, that's not time to buy. That's not good. That's not time to buy long. That's not like liquidity flooding back into the systems for the sake of growth. That's for the sake of keeping the world from not falling apart tomorrow or in a few hours. That is averting disaster. That's what happened. That's what's happening with the UK. And so that's not so like QE or the QT, switching from QT to QE. It really depends on the context, and it can't just be looked at as this overly broad brush of like, oh, liquidity is being provided, therefore long risk assets. It really depends on the circumstance.
Yeah, no, absolutely. We're almost out of time. I always feel like we're just getting going. We're almost out of time, but could both of you leave us with all of these sort of complicated issues swirling around? Can both of you leave us with sort of what, if it's not your favorite position or trade right now, the market that you're most interested in and that you're waiting on, or that you would be sort of positioning and getting ready for that setup? Jared, let's start with you.
The market that I'm most interested in, I mean, just plain vanilla stocks, really. Like, I mean, the one thing is that the bond market is way more important than the stock market. Like, for example, stocks were down 50% in 2002. Okay, it did not blow up the financial system. Bonds blew up the financial system in 2008. Fixed income really has the potential to blow up the financial system, but stocks are useful for sentiment purposes. They really tell you where sentiment is. And, I think over the next couple of weeks, we're going to have a big reversal in sentiment. And the best way to express that is in stocks. So I think the dollar is going to sell off. I think gold is going to rally. I think a lot of these trends are going to reverse. But the best way to express it is just in stocks.
Fantastic. We should say too, Jared is zipping off to Atlanta tomorrow. So
Yeah.
if any of our viewers in the Hotlanta area, you can go find him at the Four Seasons, right?
Yeah.
He's setting up camp at the bar. Unfortunately, we're tethered here. Weston, what about you? And we got to keep it briefer. I'm going to get in
Sure.
trouble. But and we have a question for you on JPY. Why can't it be resolved? The U.S. dollar swaps. I'm going to have you answer that after the show for Melson on YouTube. But what are you liking here?
JPY. So like I mentioned before, look, if you want to go long dollar yen, there is the dollar yen is being artificially suppressed right now to the to the upside. If you believe that like there will be some sort of yen intervention part 2, which there might very well maybe imminently or next week at some point. But if that happens, I would buy right against that into that sell-off, because these things don't last. As we saw, Japan bought itself 13 trading days with $20 billion the last time. So that's going to happen again. So like that's your entry point for that. I would say that look, in terms of like going long, like what Jared was saying, look, if you get a kind of like a lineup of if you get the Liz Truss cabinet to ditch their tax policy, the Bank of England's temporary QE actually worked, and it indeed was temporary, and everything was smooth with like the pension fund rebalancing, all that, and then you get perceived economic and market positive reforms out of China starting this weekend with the kickoff of China Party Congress, be it like ditching zero COVID or whatever, just the perception itself, right? And you have all-time highs on short interest on Hang Seng Index and all that kind of thing. And then you just get like all these things to line up. You can get a face-ripping risk on, squeeze to the upside. Pick your index of choice, or Bitcoin or whatever it is, risk asset of choice, to go long for kind of the shorter term, is what I would say. But at the same time, any one of those things can drop markets another leg down.
Right.
But if those things line up, and it's not out of the question that they can't, then yeah, it's going to be risk on.
And that's for you short-term traders out there. If you're long-term and risk averse, you might want to hang out on the sideline a little bit until we get some clarity. Jared and Weston, fantastic stuff. Thank you for helping us get a deeper understanding about what's going on behind just the headlines that we were all seeing today. We appreciate it.
Thank you.
Fantastic. And Ash is going to be back tomorrow with Jim Bianco, so be sure to join us for that. Thanks for the great questions. Have yourself a wonderful evening. Take care and good luck out there.